Apple shelters $2.1 billion annually using a legal tax structure most people have never heard of, and the SEC filing proves it. This is Boardroom Files Research, and today we're analyzing one of the most sophisticated corporate tax strategies ever disclosed publicly, Apple's double Irish Dutch sandwich. We're not here to judge whether it's ethical, we're here to show you exactly how it works, why the IRS permits it, and what it reveals about how Fortune 500 companies manage their tax obligations. Let's start with the raw numbers. Research shows that Apple's effective tax rate from 2009 to 2014 was approximately 6.9% on international earnings. Compare that to the statutory U.S. federal corporate tax rate of 35% at that time, and you're looking at a gap of 28 percentage points. The analysis of Apple's Form 10-K filings and Senate Finance Committee testimony reveals that this structure, the double Irish Dutch sandwich, was responsible for sheltering approximately $2.1 billion annually in taxable income. Now, before we go further, this strategy is completely legal. The IRS permits it under IRC Section 482, which governs transfer pricing between related entities. The federal government has known about these arrangements for decades. What changed isn't the legality, it's the transparency. We now have SEC disclosures, congressional testimony, and academic research that let us see exactly how it works. So how does the double Irish Dutch sandwich actually function? Let's build this step by step. The structure involves 3 entities, 2 Irish subsidiaries, and 1 Dutch company. Here's the research-backed architecture. Apple establishes an Irish holding company, let's call it Apple Operations International, or AI. AOI is incorporated in Ireland, but critically, it's not tax resident in Ireland. Why does that matter? Because Ireland has a special tax residency rule that says a company is only tax resident in Ireland if the management and control actually happen there. Since AOI's management and control happen in the United States, Apple's board meets in Cupertino. AOI isn't taxed by Ireland, even though it's incorporated there. Next, there's a second Irish entity, Apple Sales International, or SC. ASI actually is tax resident in Ireland, meaning it pays Irish corporate tax, which historically has been around 12.5%. Here's where the arbitrage happens. ASI holds the intellectual property rights to Apple's products for Europe, the Middle East, Africa, and parts of Asia. When a customer in Germany buys an iPhone, the profit flows through ASI. Then comes the Dutch company, Apple Operations Europe. It's incorporated in the Netherlands and serves as an intermediary for licensing fees. Here's the key insight from our analysis of proxy statements and 10-K disclosures. The Dutch entity exists primarily because of a difference in how the US and Dutch tax codes treated royalty deductions at the time. The Netherlands allowed broader deductions for related party royalty payments than Ireland did, so the mechanics work like this. Profits from iPhone sales in Europe accumulate in ASI, the Irish tax resident company. But ASI pays royalties to AOI, the Irish company that isn't tax resident anywhere. Those royalties reduce ASI's Irish taxable income significantly. AOI then pays those same royalties to the Dutch entity, which further reduces taxable income in that jurisdiction. Meanwhile, AOI isn't being taxed by anyone because it's not tax resident anywhere. The research data is stark. According to Apple's Form 10-K filed in 2013, Apple held $102 billion in cash overseas. Of that, the vast majority was attributed to these types of structures. By 2014, Senate Finance Committee testimony indicated that Apple's overseas entities controlled approximately $181 billion in assets while paying minimal tax to any single jurisdiction. Let's put this in perspective with comparable data. The S&P 500 average effective tax rate per BLS corporate tax analysis hovers around 18.3% when accounting for these types of strategies. The statutory rate is 21%. That 7-point gap multiplied across 500 large companies represents tens of billions in annual tax reduction. But Apple's structure was far more aggressive. Our analysis shows it reduced Apple's effective rate to single digits on offshore earnings. Now here's something critical. This wasn't unique to Apple. Data indicates that Microsoft, Google, Amazon, and dozens of other Fortune 500 companies used similar or identical structures. Academic research from the National Bureau of Economic Research quantified this in 2014, finding that approximately 60% of Fortune 500 companies utilized some form of international tax arbitrage. The mechanisms varied, but the principle was identical: exploit gaps between tax codes in different jurisdictions. What changed? In 2015, the OECD launched the Base Erosion and Profit Shifting Initiative, BEPS, which specifically targeted these structures. Research shows that over 100 countries agreed to new transfer pricing guidance that made the double Irish Dutch sandwich significantly less effective. By 2020, Ireland and the Netherlands had both closed the specific loopholes that enabled it. But here's the remarkable part: the strategies didn't disappear, they evolved. Our analysis of more recent 10K filings shows companies shifting to similar but updated structures, often involving Puerto Rico tax incentives under Act 60, Singapore subsidiary arrangements, or Luxembourg intellectual property holding companies. The SEC disclosure process is how we know all this. Companies are required to disclose tax positions that involve uncertainty or that could reasonably be challenged by tax authorities. Apple's Form 10K footnotes, particularly footnote 18 on income taxes, laid out exactly what was happening. Congressional testimony from Apple executives, including CEO Tim Cook, further confirmed the mechanics. When asked directly about the structure by Senator Carl Levin, Cook acknowledged it, defended it as legal, and argued that it was no different from what any responsible company should do. Here's what the research reveals about why the IRS permits this. IRC Section 482 requires that related party transactions be priced at arm's length, meaning the same price two unrelated parties would agree to. The IRS's position has been that if the transfer pricing documentation supports the value of the royalty payments and licensing arrangements, the structure is defensible. Apple maintained detailed transfer pricing documentation, commissioning studies from major accounting firms to justify the royalty rates and IP valuations. The 2016 European Commission decision offers a counterpoint. The Commission alleged that Ireland's tax rulings favoring Apple were state aid, essentially illegal subsidies. The Commission demanded Apple pay back euros 13 billion, approximately $14.5 billion at 2016 exchange rates. Ireland and Apple fought this for years. The case finally went to the EU General Court in 2020. And the court sided with Apple and Ireland, ruling that the Commission hadn't proven its case. This 2020 ruling is significant. It shows that even when tax authorities challenge these structures aggressively, the burden of proof is extraordinarily high. Data from the Joint Committee on Taxation indicates that similar structures in the U.S. cost the federal government approximately $60 billion annually in foregone tax revenue, across all companies using variants of these strategies. When you multiply that across multiple years, you're looking at corporate tax avoidance in the hundreds of billions of dollars range. So what does this mean for the broader business ecosystem? Research suggests that smaller companies, which can't afford the sophisticated infrastructure and legal teams required to establish and maintain these structures, effectively pay higher tax rates. A mid-sized manufacturer with $500 million in revenue might have an effective tax rate of 25%, while Apple pays 6 to 9% on international earnings. This creates a competitive arbitrage at the corporate level. Larger companies get a structural tax advantage. The story continues today. The 2021 OECD Pillar 2 agreement, signed by 130-plus countries, commits to a 15% global minimum tax. This is directly targeted at eliminating the incentive for these structures. Research from the Tax Foundation indicates that implementation will reduce the attractiveness of tax havens, but not eliminate them. Companies are already exploring post-Pillar 2 structures. What we've learned from analyzing Apple's case is that corporate tax strategy isn't some shadowy conspiracy. It's explicitly disclosed, heavily regulated, and fundamentally shaped by written tax code. The research shows that companies operate within the law, but they operate at its very edge. The IRS knows about these structures. Congress knows about them. The court system has validated them repeatedly. What changed was transparency. The public now knows about them too. The double Irish-Dutch sandwich is now largely defunct, but the principle it represents, tax arbitrage through jurisdiction shopping, remains alive and evolving. Every major multinational company has a team of tax specialists working to identify and exploit differences between tax codes. It's not illegal. It's not even particularly